Welcome, curious minds, to another deep dive. Today, we're looking past what might seem like, well, dry financial documents. We're actually uncovering this incredible story of how India's financial markets are changing really fast. It's transforming how millions save and invest. Our mission: simple. Cut through the jargon, pull out the most important, maybe even surprising, insights. We want you to walk away feeling you really get it, maybe even a little amazed.
Exactly. And we're setting the stage for what is an incredibly dynamic financial landscape in India right now.
Yeah.
What's truly fascinating, I think, is this fundamental shift happening. People are moving, away from mostly physical assets, think gold, real estate, towards financial assets. And this isn't just happening randomly. It's really being pushed by growing financial literacy, big tech advancements, much simpler investment processes now, and also, crucially, these big initiatives promoting financial inclusion and education right across the country.
That's the big picture. And today, in this deep dive, we'll explore the key roles played by things like mutual funds, alternative investment funds, and also other important players, portfolio management services, REITs, NVTs, you name it. They're all sort of channeling everyday savings from people like you into the capital markets. The goal is you leave feeling informed, yeah, but maybe also a bit surprised by what's actually happening on the ground.
Okay, let's unpack this. Let's kick things off with something I found genuinely astounding. The sheer exponential growth of India's mutual fund industry. It's been nothing short of explosive, really. We're seeing this huge surge in assets under management, AUM, and just way more people getting involved. And it seems to be fueled by, like you said, better financial literacy, rising incomes, tech making things easier, and also some pretty solid regulatory support.
It's not just abstract growth either. The numbers, well, they really tell the story. Mutual fund AUM has, get this, tripled in just 5 years. It shot up from 22.3 lakh crore back in March 2020 to an incredible 65.7 lakh crore by March 2025.
Wow.
And it's not just the money pouring in. The number of investors is growing fast, too. Unique investors went from 4.5 crore at the end of March 2024 to 5.4 crore just a year later, March 2025. A lot of this expansion is really built on the back of systematic investment plans, SIPs. They're becoming so popular, they really encourage that disciplined long-term investing habit for millions. What's fascinating here is how these small, regular bits add up to such massive amounts.
Right, and who's sort of guiding all this huge growth. That really brings us to SEBI, the Securities and Exchange Board of India. Their role seems absolutely crucial here. They're steering this whole thing with very targeted reforms, it looks like. And these initiatives, they aim to boost transparency, make operations smoother, protect investors, all things that build trust and bring more people into the market, right?
Precisely. SEBI's strategic thinking is pretty clear in the policy changes for mutual funds just in 2024-25. Take Chhoti SIP, for example. This idea for financial inclusion is basically saccadization, making mutual funds available in really small, affordable packets.
Like those little shampoo sachets.
Exactly like that.
Yeah.
Chhoti SIP lets investors start with, believe it or not, just 250. It's specifically designed to reach people who were previously left out, maybe in more remote areas. And key market players have even cut their charges to help support these tiny SIPs. This isn't just small change. It's strategically unlocking a huge potential market. It's about democratizing wealth creation, really.
That's powerful. What else?
Then there's the Mutual Fund Lite framework. This is a simpler set of rules for passively managed funds, the ones that just track an index instead of actively picking stocks. The goal is to make that kind of investing cheaper and easier to access. So they've relaxed some rules for sponsors, cut down on some compliance paperwork, hoping to spur some innovation too. They even brought in a new category, hybrid passive funds. Lets you invest in one product that tracks both stocks and bonds, sort of a balanced approach, all in one.
Interesting.
And we also have specialized investment funds, or SUFs. Now, this is a new kind of product. It tries to fill a gap, between standard mutual funds and the more bespoke portfolio management services, PMS. SEFs offer more flexibility in how they invest across stocks, bonds, hybrids, even some derivatives. But they do require a higher minimum investment, 10 lakh from most investors. The idea is to add more variety to the kinds of pooled investments available domestically, more tailored options.
That does sound like it offers more flexibility, but does that also mean more complexity, maybe more risk?
It certainly means investors need to understand what they're getting into, yes. The higher minimum reflects that. But it's about providing choice across the spectrum.
Got it. So quite a few significant changes just on the fund structures. And SEBI didn't stop there, did they? They rolled out a whole bunch of other reforms this year, too. It seems like a really comprehensive approach. It feels like they're tackling things from two angles. First, rules for the fund managers themselves, getting their interests aligned with investors, like the revised skin in the game rules starting April 2025. Now, it ties the investment required from key employees to their salary, right, and cuts the lock-in if they leave early.
Yes, exactly. From 3 years down to 1 year lock-in for those leaving before superannuation. It encourages commitment, but adds flexibility. And AMCs, the asset management companies, now have to put systems in place to actively spot and stop things like front-running or fraud. Plus, whistleblower mechanisms to boost transparency internally.
Okay, so that's the manager side. What about protecting investors more directly?
Well, a big one. From November 1st, 2024, mutual fund units fall under the insider trading regulations. That's a major step up in oversight. Then, to tackle mis-selling something lots of investors worry about, there are new rules on commissions. If you switch from an existing fund to a new fund offer, or NFO, the commission paid can't be higher than the lower of the two schemes' rates.
Ah, okay, so no incentive to push switches just for higher fees.
Precisely. And there are also strict timelines for NFO fund deployment. Money raised in an NFO has to be invested within 30 business days, according to the fund's plan. Stops them just collecting cash without a clear strategy.
Makes sense.
And finally, lots of enhanced disclosures. Equity funds now need to show risk-adjusted returns using something called the information ratio. It basically helps you see how well the manager did relative to the risk they took compared to a benchmark. Plus, clearer breakdowns of expenses, returns for direct versus regular plans, and standard risk-o-meters, just giving you a clearer picture.
That's a lot of changes, but they all seem focused on making the market work better for the end investor.
If we connect this to the bigger picture, yeah, all these reforms, you can see their impact in the market activity. It's observable.
Absolutely. I mean, look at the number of new schemes launched, up nearly 33% to 247 in 2024-25, mostly open-ended ones. And the money flowing in. It's just remarkable. Gross funds mobilized hit 137 lakh crore, and net inflows, the money staying in, surged almost 130% to 8.2 lakh crore. That's apparently the highest net inflow ever recorded in a financial year.
It is. And it's worth noting, private sector mutual funds brought in the lion's share, about 88% of those net inflows. Shows where the momentum is.
So where is all this money going? What are the trends?
Well, one clear trend is passive investing. It just keeps growing. The number of registered index funds jumped from 200 to 309. Net inflows into passive funds were up substantially too. And what's really interesting here, net inflows into gold ETFs actually tripled.
Tripled, wow.
Seems directly linked to rising gold prices. Investors clearly reacted to that signal on the market. It shows how people are using ETFs to play specific market themes.
Okay, what about the traditional equity and debt funds?
For equity and debt, we saw a net inflow of 4.2 lakh crore into equity-oriented schemes. Lots of different categories contributing there. On the debt side, money market funds and liquid funds got the biggest inflows. Some other debt categories did see money flow out, though. As for deployment, where the money actually got invested, by March 2025, over half, 52.6% of equity assets were in just 5 sectors. Financial services was the biggest chunk, nearly 28%, followed by software at around 7.6%. For debt funds, bank CDs, and government securities, GSECs were the main areas, about 19% each.
And what about returns? With all this growth, were returns fantastic across the board?
Well, that's where the picture gets a bit more nuanced. It wasn't all up, up, up. The number of funds showing negative annual returns actually jumped quite a bit in 2024-25, from 96 the previous year to 243.
Really? That's surprising.
And conversely, fewer funds delivered higher returns. Those giving over 5% dropped from 1,326 to 11,156, and those returning over 10% fell from 822 down to 304. So it suggests a more, let's say, tempered return environment. The market might be maturing past that initial explosive growth phase. It probably means investors need to focus more on steady, long-term strategies rather than just chasing quick gains, aligning with the market's maybe new rhythm.
Right, managing expectations. But here's where it gets really interesting for you, the individual investor listening. The investor base itself is just exploding. The industry added 5.7 crore new accounts folios in just 1 year, 2024-25. Bringing the total to a massive 23.5 crore folios. And it's mostly individuals, 97.4% of the accounts, and holding nearly 60% of the total assets. But what's truly remarkable, I think, is the deepening reach into Tier 3 cities. Those outreach efforts, maybe the Chhoti SIPs too, are clearly working. The unique investor count there grew from 2.6 crore to 3.3 crore. That's significant penetration beyond the big metros. Finance is getting
It
democratized.
really is.
And SIPs, as we mentioned, are just a cornerstone of this growth. The number of SIP accounts, up almost 20% to over 10 crore. And the average amount flowing in monthly via SIPs jumped nearly 80%, reaching over 13,000 crore a month. And that Chhoti SIP impact, you can see it, over 1.1 crore SIP accounts have less than 500 in them. That's powerful evidence of accessibility.
Definitely. But it's also important to touch on a couple of risk and operational points. While the percentage of defaulted debt within funds actually went down significantly, which is good news, unclaimed money did go up. Unclaimed redemptions reached 11,128 crore, and unclaimed dividends hit 2,324 crore.
So people need to make sure their contact details are up to date.
Absolutely crucial. Keep those details current. Also, the mutual fund stress test results offer some useful insights. They test how quickly funds could sell assets under pressure. Mid-cap funds, on average, needed about 7 days to sell off half their portfolio. Small-cap funds, though, needed longer, average 16 days. And for the top 3 small-cap schemes, it could take as long as 50 days to liquidate half the portfolio.
50 days, that's quite a while.
It is. So the key takeaway for you, if you're looking at small or mid-caps, is yes, potential for higher growth. But you need to be aware of this liquidity aspect. Be prepared for a potentially longer exit if the market hits a really rough patch.
Okay, good to know. So mutual funds are clearly massive and reaching more people, but where's the sort of more sophisticated, perhaps riskier capital being deployed? That brings us to alternative investment funds, or AIFs, right? Another key part of the ecosystem.
Exactly. AIFs cater to a different segment, often more sophisticated or institutional investors, and they've also seen continued growth. And SEBI's been active here too, strengthening oversight, but also adding operational flexibility. One interesting change is flexibility for unliquidated investments. Before, winding up a fund with assets they couldn't sell was complicated. Now there's a framework to hold those assets longer within the same scheme, entering a dissolution period. It just simplifies the whole winding up process.
Okay, makes it cleaner.
Then they've allowed certain AIFs category I and II the ability for creating encumbrances. Basically, they can use the equity of infrastructure companies they invest in as collateral to raise debt. Helps finance big infrastructure projects, which is vital.
Right.
They've also modified eligibility criteria for the key investment teams. Instead of needing years of experience, there's now a certification requirement. This could encourage more first-time managers, bring new talent into the AIF space.
So opening it up a bit.
Yeah. And there's a new due diligence obligation. AIFs and managers have to be careful. Their structure isn't being used to get around other financial rules, banking norms, foreign exchange rules, things like that. Finally, they clarified the pro rata and pari passu rights. Generally means all investors in an AIF are treated fairly and equally in proportion to their investment, though there's flexibility for things like blended finance.
Seems like these tweaks are greasing the wheels for AIFs. Is that showing up in the numbers?
It certainly looks like it. The total number of registered AIFs climbed to 1,526, and the total money committed to AIFs, up almost 19% to nearly 13.5 lakh crore. Funds actually raised and investments made also saw big jumps, about 25% and 32% respectively. Category 2 AIFs, which include private equity and debt funds, are still the dominant players here. Within Category 1, venture capital leads the way.
And where are these AIFs putting their capital?
A big chunk, almost 40%, goes into unlisted company shares and related instruments. Another 28% into listed shares. Sector-wise, real estate gets the most, about 13%, then IT and related services at 6.4%, and financial services at 5.1%. And to give you a concrete example of their impact, AIFs invested nearly 20,000 crore specifically in startups as of March 2025. Shows their critical role in funding innovation in new businesses.
Okay, so that's AIFs covered. What about the other specialized areas? Let's start with portfolio management services, PMS. How are they doing?
PMS is also growing. Remember, this offers a more personalized investment management service. The number of registered portfolio managers went up by over 12% to 472. Client numbers grew even faster, up nearly 23% to almost 2 lakh clients. And for better oversight, PMS distributors now need to register with their industry body, APMI.
More oversight. And for clients?
Digital onboarding got easier, allowing typed notes instead of handwritten ones, simplifying the paperwork. And more disclosures are required in client agreements now, things like fee illustrations, and a clear, most important terms and conditions document. More transparency up front. In terms of assets, total AUM for PMS grew almost 14% to 37.8 lakh crore, mostly in the discretionary segment where managers have more control. And interestingly, co-investment AUM, where PMS invests alongside other investors, saw huge growth, up over 200%.
Wow. Okay, now let's shift to those interesting vehicles. Real estate investment trusts, REITs, and infrastructure investment trusts, NVETs. These are pretty innovative, right? Letting people invest in big property or infrastructure assets.
Exactly. They let developers unlock capital from income-generating assets, like office parks or highways, and they offer investors like you a way to get regular income and diversification without having to buy the whole asset directly. It's like owning a fraction.
And SEBI's been active here too.
Yes, several measures in 2024-25 to boost this ecosystem. They introduced a subordinate units framework for privately placed NVITs. It's a mechanism to help bridge valuation gaps when an NVIT buys an existing infrastructure project, makes deals smoother.
Okay.
There's also now a framework for unit-based employee benefit schemes. This lets the managers of REITs and NVITs offer units to their employees, aligning their interests directly with the investors. If the trust does well, everyone benefits.
Smart. Incentivizing performance.
And lots of moves for streamlined compliance and ease of doing business. Things like reducing procedural steps, aligning reporting timelines, allowing faster unit holder meetings with electronic options, just making things more efficient and modern. They also lowered the minimum trading lot for privately placed invites to 25 lakh, potentially broadening the investor base slightly.
So is this market taking off?
It's certainly growing. The number of registered invites rose to 26, with 22 listed, REITs up to 6 with 4 listed. And excitingly, those SM REITs, small, medium ones, were introduced in March 2024, and 4 are already registered. That could open up real estate investing considerably. In terms of funds raised, invites mobilized over 26,700 crore and REITs nearly 4,700 crore in the period, so significant activity.
And what about protecting investors in these structures?
Protection is key. Units have to be held electronically, dematerialized form. Applications for public issues use standard secure methods like ASBA or UPI. There are rules to ensure diversification. They need at least 25% public unit holding and a minimum number of investors to avoid concentration risk. And importantly, there's the sponsor skin in the game rule. The sponsors, the ones setting up the trust, have to hold a significant chunk of units themselves, at least 15% for the first 3 years after listing. This percentage then reduces gradually over time, but it ensures they have a long-term vested interest aligned with other unit holders. Shows they believe in the assets.
That makes a lot of sense. Ensures alignment. Wow, we've covered a huge amount today, just an incredible breadth and depth of developments. It's really clear, isn't it? India's financial landscape isn't just getting bigger, it's getting much more sophisticated, much more accessible too. From those tiny Chhoti SIPs making investing possible for almost anyone, right up to the complex structures of AIFs, PMS, and these growing REITs and InvITs, there's this clear thread running through it all. Improving transparency, protecting you, the investor, and really fostering innovation.
That's right. And I think the core takeaway for you listening is this. These aren't just abstract changes. They signal a truly dynamic environment, one that's full of evolving opportunities. Staying informed about these shifts, well, it isn't just about understanding the market. It's about understanding the actual mechanisms shaping how wealth is created and how financial empowerment is spreading for millions across India. It's a story that's constantly unfolding.
A story still being written. So here's a final thought to leave you with. As India's financial landscape keeps climbing this steep path, pushing both accessibility and innovation forward, what future investment opportunities might emerge that could completely reshape how you think about your own long-term financial goals?